If Interactive Brokers Trader Workstation looks confusing and you just want to buy a call option and do it right, you're not alone. I've helped plenty of beginners get past this first roadblock, and in this video, I will show you how to buy a call option step by step. And I'll explain everything in plain English so you'll be able to do it too, even if you're brand new to options trading. First, you need to boot up Interactive Brokers Trader Workstation, aka TWS, and then we need to go into the options chain. This is the place that contains a list of all the call and put options for the stock you want. It's like a catalog of contracts for you to choose from. I have an options chain already laid out in my TWS already, and you can search for a stock's name in the top left-hand corner up here. I will use Apple and type the stock short form name AAPL. But if you don't have an options chain already on the screen, just right click the stock you're interested in on your watch list. I'll go to Apple right here, right click, go down to trading tools and click on options chain and one will pop up for you. Looking at all the contracts on the left-hand side, you're going to be seeing the calls. On the right-hand side, you'll be seeing the puts. Today, we're focusing on calls only. And here's the easiest way to remember how a call option works. If you think a stock will go up in price, you would buy a call option. And as a stock goes up, a long call, aka a call you buy, also goes up, making you money. Now, there are two important decisions you have to make to set up your call option trade properly. When buying a call option, you need to select an expiration date. This is how long the call option contract lasts for, and every contract expires, so if the date is too close, think 7 to 30 days, the call option is going to be cheaper, but also risky. If the date is far away, like 90 to 120 days, the call option costs more, but it gives you more time to be right and for the stock price to go up. The other key choice is which strike price to use. These are the numbers in between the call and the put side of the options chain. And picking a strike price right at the current stock price is known as an at the money call. This is what a lot of traders do, or they'll buy calls at strike prices much higher than the current stock price because it's way, way cheaper. But it's only cheaper because the odds of making money are way less. I prefer to buy calls at strike prices that are lower than the current stock price, known as in the money calls. They cost more, but they give you better odds of winning your trades as the stock price goes up. Now that you know that, let me show you how much it'll cost you to buy your call option. You can see a variety of numbers on the call side of the options chain. We want to focus on the bid and ask columns. These are the current prices of each call contract, and 99% of the time, you will end up making a trade at the price in between these two numbers. This is known as the mid price. For example, at this 200 strike call option, you would be paying between $8.85 and $82.05, or somewhere around $81.50. If you went for this 270 strike call option, you'd be paying between $21.20 and $21.35, which is right around $21.27. And this midpoint is the amount of cash, aka the premium, that you're going to need to pay to buy the call option. And it's showing it in price per share. Since every contract has 100 shares, if the premium shown here is $21.35, that means that the total cost of the call option is $21.35 times 100, or $2,135. And that amount is also your max loss when buying a call option. You cannot lose more than what you pay for the contract. But how about figuring out how high the stock price has to go before you'll win your trade? Well, the point where you will 100% make money is known as the break-even price. And the super easy way to calculate this is by taking the strike price of your call option and add the premium you paid to buy the contract. For a call option with a strike price of 270 and a premium of 21.15, our break-even price would be 291.20. If Apple's price is above 291.20 when the contract expires, you'd make money. And if it's lower than that at expiration, you're going to lose money. But the profit is technically unlimited when buying a call since a stock can go up in price forever. And if the stock starts going up the second after you buy a call option, your trade will show a profit. That happens because of something called delta. And you can see the value of delta in this column right here. This number shows you how much your call option will move when the stock price moves. If the delta is 0.54, this means that the stock going up $1 causes this option contract to go up 54 cents because of the delta. But it's not the only thing affecting the value of your call contract. There's also time decay known as theta, which causes your call to lose a little value each day, even if the stock doesn't move. The value of theta can be seen in this column right here. So for every day that goes by for this contract at 280, you'd be losing about 8 cents per day. Now that you know that, let me show you how to actually buy a call option so you can make some money when your favorite stock moves higher. Inside the options chain, just select your preferred expiration date. I'm going to go with this February 20th one right here. Then choose the strike price that you want from the list of options here and click on the ask price of the strike that you want. I'm going to choose this 260 strike price right here and click on the ask right there in blue. This will automatically pop up a buy order into your order entry area. Then just double check that you are actually buying. So this background here is blue. Choose a quantity of 1, so you're only buying one contract made up of 100 shares. Choose an LMT order from the list of potential order types. LMT stands for limit order, and this allows you to specify the amount you are willing to buy the call option for. Then click where it says mid right up here, in between the bid and ask, at the top of the order entry area to get the best possible price. Click the advance button and then margin performance right here, and a screen will pop up showing you your probability of making money, your max return, your max loss, and your break-even price for this trade at 285.92. Then click Transmit to submit your order. It may take a minute to fill and go from an order to an actual trade, but you can check the status of that in your activity area right here. Once it goes from an order to a trade and it's live, you can monitor it in your portfolio area to see if it's up or down as the stock price moves. To find your portfolio area, just come over here to where it says Portfolio and scroll down to your trade, which we can see February 20th expiration right there. Next, let me explain how to close the trade if you want to take profit or cut off a loss. And make sure to subscribe to the channel if you're getting value so far. So this part causes a lot of beginners to freeze because they just aren't sure how to exit their position. But it's actually very simple. You just do the opposite of what opened the trade. You sell the call contract. The best part is Interactive Brokers created a button to make this super easy. Just go into your portfolio, right-click the position that you want to exit, click the close button, and this will create an order to sell off and close your position automatically. Make sure you use the LMT or the limit order again. Click the mid to get the best price, then click submit to transmit the order, and that closes off the call. You can see there's a $23 profit in there in our trade area. Now, how do you avoid taking too much risk buying calls? You need to have a plan before you open up your trade. It's like having a strategy worked out before you start a board game. The first part of your plan should be a stop loss. This protects you from losing too much money on the trade and is just a percentage of the amount you paid to buy the call option. If you paid $1,000, you only want to lose $500. If the call didn't work out, you would close the trade for a 50% loss instead of 100%. And this is a good rule of thumb for beginner option buyers. Next, you need a goal for when to take profit. Typically, it'll be based on the stock moving up to a certain price, but I prefer to have a set percentage. So when a call option goes up 20 to 30%, that's where I like to close. That would be like a $1,000 call option going to $1,200 or $1,300. Having these set targets for closing when the trade goes wrong or right helps to remove the emotional struggle traders face and make the decision more like following a rule. But where do you see how much profit or loss your trade currently has after you buy it so you know when to close it? Inside of your portfolio area, you can see all of your trades. And if you add a column called unrealized P&L or profit and loss, you'll be able to see the exact percentage of your position. If you don't have this column already in your portfolio area, just hover over one of your columns, click Insert Column, go to Position and P&L, and then click Unrealized P&L from the list there. Then just make sure to hover over that and right-click, and go down to Display Value and display both a value and a percentage by clicking Display Both. And that's how you'll be able to see if a trade goes positive or negative. Next, let's put everything together in a short example trade, and then I'll share the top 5 beginner mistakes that I see traders make when they buy calls. So from my watch list, I'm going to click on the company Tesla. And Tesla's been in a nice long-term upward trend for the past few months. So I want to buy a call option thinking that this trend will continue. Then I'm going to open up my options chain on Tesla, and I'm going to go out in time to right around 120 days. Let's go to April 17th, 2026. That's the expiration date. Then I want to choose a delta of around 70, maybe 75 on the call option side, which gives me a strike price in here. Let's use the 400 strike price. I click on the ask button right there. I'm making sure that I'm going to buy. Quantity is 1 contract or 100 shares. I use a limit order in LMT. I click the mid price up here, and then I click Advanced, and I go Margin Performance. And I can see that I have a 42% chance of winning this trade, making money. My max return is infinite. My max loss is $9,000 and change, and I have a break even of 491.50. I'm going to click Transmit. I'm going to back out of here. And in my activity area, you can see the trade right there at the top went through. It's now a full trade. And if I go into my portfolio area right here, I can see that I have a Tesla 400 call right there with $6 of profit right now, $10. It keeps going up because Tesla keeps going up. And if I wanted to close that off, I would right click it, click on close. It would populate the order for me to automatically close. I would make sure my quantity is 1 using a limit order again from the list. I would click on mid and I would click submit. And that trade netted me $2.22 of profit. Now that you have an example to review whatever you want, here are the biggest red flags to avoid with this strategy. So first off, don't pick expiration dates that are just too close. That's anything that's 4 weeks or less. Time decay eats away at the contract too fast, and you need the stock to move higher pretty much right away. Next, don't pick very cheap strike prices that are far away from the stock price. These are like lotto tickets and have very low chances of paying off. And don't use market orders on options. Always use a limit order to get the best price possible. You shouldn't buy calls on risky or unproven companies. They're hard to predict and they can go negative very quickly since the company isn't established. It's better to focus on ones that are, like in the S&P 500 if you're a beginner. And don't forget to close the trade before it expires. You don't want to let the contract expire. Use the steps we just went through to lock in your profit earlier. And now that you know how to buy a call option on the Interactive Brokers Trader Workstation, you can profit when a stock goes up. But what if you could profit if a stock goes up, stays flat, or even goes down a bit? To learn how, check out this video next.